Welcome to the Currency of Knowledge, a County National Bank wealth management podcast, the podcast where we unravel the layers of prosperity, explore the diverse meanings of wealth, and delve into the stories of those who have built their own versions of abundance. I'm your co-host, Christopher Phillips.
And I'm Holly Baker. Join us on this insightful journey as we redefine wealth beyond the balance sheets and uncover the true riches that life has to offer. Let's explore the essence of wealth in all its forms. Welcome to the Currency of Knowledge. We are excited to have Paul Lehman here. He is from Dimensional Fund Advisors, who we have the pleasure of working with in the wealth management group. Just a quick bio for you, and then I'm going to ask you all about yourself. Okay. So I have here that you are the head of the bank trust group and you're a vice president. So you have about 30 years of experience in this area. So if you can tell us a little bit about yourself personally, and then some about how you managed to get into this field.
Sure, absolutely. Thanks for having me. This is going to be fun. About 30 years. I think as you age, you start to say about when it's actually more than. I think I'm in year 32 at this point. So how I got to Dimensional or how I got into the industry?
Let's start with how you got into the industry.
Okay. Well, I am originally from Toledo, Ohio. This is going now way back.
Okay. Does this mean go Buckeyes?
Buckeyes. Yes, go Buckeyes.
Go Buckeyes.
Where'd that come from?
From here.
Yeah.
I knew what you were saying.
Thank
yes.
you.
Yes, go Buckeyes. And so just down the road from where we sit today, and my folks are still there. In fact, later today, I'm going to drive down and spend some time with them. So It's nice to be here for lots of different reasons. Yeah. Growing up in Ohio, and it's particularly in Northwest Ohio, there were a lot of banks. There were a lot of big banks, a lot of Cleveland-based banks that were around. And so my first job coming out of high school, this is while I was in college, was working for a bank. I wasn't in the wealth management group yet, but I was working, sitting in a bank branch and opening checking accounts and taking loan applications. And
the hardest job in the bank.
It was the hardest job.
Yeah,
that's right.
It's the hardest job in the bank. Yeah.
It is, yes, because anytime a disgruntled customer might come in, they said, well, go talk to Paul, and then he'll get you to the right place.
Great training ground.
It was. That's right. So while I was there, though, I got to know the folks that worked in our wealth management group, because part of my job was to make some introductions to people. If I were talking to somebody and they expressed some desire, or if I saw some need perhaps for the folks on our wealth team to provide some help, then my job was to make the introduction to that group. And so the more I got to know them, the more I really started being intrigued by the role that they played in the lives of my clients, my customers, as they came in. And so I went through college, and when I got out of college, it became a really natural next step for me. One, to stay in banking, but two, to go into the wealth management side of banking. So right out of college, my first job was providing financial advice. Had to go through all the licensing that you have to do in the industry. But once I did that, I worked for the banks, but in the wealth management group. Okay. And so that was 93. And so from that day forward, I worked for banks for about 20 years. And then in 2013, joined Dimensional Fund Advisors, and now I work with banks. Okay. So for my entire career, it's either been working for banks or working with banks. So clearly, there's something, I'm all in. I'm stuck in working with banks, and it's been wonderful.
Good. And then, so what made you decide to almost switch from individuals to what we would call institutions, since you're with banks now?
Well, that's a good question. There was no sort of desire to do something different. I'll tell you the why I made the move, because in my role working with individuals on behalf of the bank, the role that I had prior to coming to Dimensional was I was a chief investment officer for a bank down in the Southeast. And for lots of different reasons, we used many different investment managers in our portfolios. Most of that was I inherited as I moved into the role of CIO. Nevertheless, we built what we thought were really good portfolios, and they used lots of different managers. We began using Dimensional in 2007, 2008. In about 2008, I started to learn more and more and more about the way that Dimensional invests because we began using Dimensional. And between 2008 and 2013, I had almost this personal fiduciary pull towards this style of investing that Dimensional uses. And I made the decision at one point to say, I just want to spend my entire life talking about this. I want to help people who are helping others, but I want to tell this story. And I want to be in a position to take what I had learned from being on your side of the desk, if you will, to a position where it would be a partner to you. Because I think that most firms don't really, that do what Dimensional does, don't really understand what you guys do. They understand the investing and they understand all of those things. But when it comes to actually understanding what it's like to talk with clients, to work with clients on a generational basis, multi-generational basis, there's so much more to that than just, well, here's what the return was, or here's what the expenses are, or, those sorts of things. And so I thought I would be in a unique position to be able to provide some insight that maybe would be rare for other folks that you work with out there in the industry. And that has proven to be true. I think I've really, really enjoyed that part of it. In fact, I like having the sort of conversations that deal with, talk to me about what your clients are saying to you and what questions they have. What fears do they have? Right. And, the nature of life is, one of the things that they might be worried about today, just give it a little bit and that'll go away, and then there'll be some new thing that's going to pop up. Right. And understanding that that's the way I think we can add the most value, even as an asset manager, we can add the most value to you, is truly understanding what it is that in your client conversations are most important. And then let's provide whatever resources we can to help you through those conversations and help your clients, most importantly, kind of stay put. I mean, the work that you all do with clients, you get to know them really, really well. Maybe you understand them more than maybe anybody else who's not a family member inside their lives. It's just the nature of it.
We know a lot about them. That's for
right.
Sure.
That's right.
Yeah.
That's right.
And we take that super seriously, and that's the reason why I love the work that we do, is because we work with great partners like Dimensional. But what I like to do is understand really what is making that client tick, really understanding what does this portfolio need to do to drive happiness, to drive value for this client. And that's where we get really excited about the conversations that we have with our clients.
Yeah, it's fascinating. It's wonderful. It is, I think of it as being really, really noble work, a high calling, because this is fear, financial fear, stress is one of the top stressors in all of our lives. That's what all the data shows, health and finances. These are causes of stress. And isn't it interesting that it really doesn't matter the level of wealth, and I know we're going to talk about wealth, it really, or net worth, it really doesn't matter, does it?
No.
We all think, well, the more I have, I'm sure at some point I'll be able to just relax. Right. And what I'm sure you have found is that it's always this source of potential concern and anxiety. So your role is in many ways to be the financial counselor, if you will.
Right.
And the plan that you put together in collaboration with them is very, very well thought out, oftentimes very, very specific to that person. The worst thing that could happen is if they jump out. If they say, I can't do it anymore, that's the worst thing that can happen, because that's the way they guarantee that they won't have the life that they want to have.
And if you do this long enough, you will have those conversations with clients. And the days where I feel the most without success, let's say, almost a failure, is when I can't convince the client to stay in the seat. And I always say, you never get out of the roller coaster in the scariest part.
Yeah.
That's how you get killed.
Right, that's right.
And that's the same is true for investments.
That's right. Yeah. That's why I think the role that you play is so important. It really is.
Yeah. Well, thank you for that. I do want to talk a little bit about, how you got to Dimensional when you were serving as CIO.
Sure, yes.
But before we do that, I'd like to talk a little just about Paul.
Yeah.
I know you said you're from Toledo.
I am.
One interesting fact that I'm always just would love to talk about all day with you about is your triplets. You have triplet.
Yes, we do. Yes.
That's not a common thing maybe it's more common now than it once was, but what was it like to raise three kids at once?
The first thing I'll say is that's where all my hair went. I like to say I had a full head of hair. It's gorgeous. And then they said, and here are your ultrasound results, and congratulations, there are 3 heartbeats in there. And it just all fell out, I think, that day. So it was a shock to us. Christopher, though, we don't have any other children, so we didn't have one already at home. And I think that really, really helped because it was just a first pregnancy.
Right.
Okay.
You don't know what you don't know.
Sure.
You're a little bit anxious, but you're mostly excited. Right, and so it really didn't matter if there was 1 or 3 or 5. It had that same sort of energy to it. I think had we had one at home, our first reaction would have been, "Oh my gosh, 1 was hard enough. What are we going to do with 3?" So I think we were kind of blessed in that way.
I guess if you don't know any different, it's just the way it is.
It's just the way it is.
Right.
Yeah.
And tell us, boys or girls?
2 girls and a boy.
Okay.
2 girls and a boy. They are now 21 years old. They are just starting to graduate from college. So we had just one graduate a semester early in December.
Okay.
Another one's going to graduate in May. And then the third one, our son, is a double major. He'll graduate, maybe a semester beyond late because of the double major.
Sure.
So
following in your footsteps?
Yes. No, none of them are at all. Getting into finance or banking. I do have a niece, though, who is going to be coming this way. So no, they have no interest. It's probably one of those familiarity things.
Sure.
You grow up and most of us, you have to come around to really appreciating what your parents did, and you spend most of our early lives just not wanting to, just whatever they say, let's just do the opposite. Sure. Yes, so maybe there's some of that to it as well, but it's been great. I mean, to tie it to Dimensional, this might be a little of a clumsy tie, but maybe it makes sense. Dimensional is a very systematic investment manager. We don't just do things by hunches and guesses and on whims and that sort of thing. We're very systematic in what we do. When we raised our children, we were very systematic.
You had to be.
You had to be.
Yeah.
It was almost like a conveyor belt. As you move one along, one's got to take the diapers off, the next one puts the powder, the next one, it's all of this stuff. But the problem was it was 3-on-2. So we had to play a little zone.
Yeah.
Defense.
Someone is always going to get through.
That's right.
From time to time.
Exactly right. So how we got through it is, let's have a plan. Let's stick to the plan as much as we can. When inevitably you couldn't follow the plan, you didn't. Okay, it's all right. We don't have to lose our heads over this. Let's just get back to what we know. And then you ultimately have to trust that you're just doing the right things. You don't know what the outcome's going to be. So you can't. It would be nice to be able to know what the outcome is going to be, and then go back in time and see, is this going to be the right process? But you don't know. So I think with all of our decisions, you have to judge it by the quality of the process and the inputs. We don't have the luxury of judging it by the quality of the outputs. So you do something that in your heart you think is the absolute best that you can do, and you have to trust that that'll work out.
Gotcha.
Yeah.
That's great.
Yeah.
So, when we chose to work with Dimensional, we chose them because of their process, like you said, this discipline.
Yes.
In the approach, and this sort of, for lack of a better word, maybe dogmatic approach as well. So can you talk a little bit about the Dimensional approach and as you were sitting in the CIO seat at the bank, why you moved towards Dimensional?
So I think there are 2 questions there. One is explaining really what is at the heart of what Dimensional does, and then the other is, as an advisor, as a practitioner, where does that really mesh with what we were trying to do? So I'll take the Dimensional part first.
Okay.
Yes. So Dimensional is very systematic. We are very disciplined. If we are dogmatic about anything, it's this. only do what the tallest stack of evidence tells you is right to do. And when it comes to investing, we're fortunate. We've got 90 years worth of evidence, if you will. Markets have been around for 90 years in the US. We have a whole globe now of liquid, well-functioning markets all over the world that we can learn from. So Dimensional's main philosophy is, instead of going to the market and trying to tell it where it's all wrong, instead of that, let's be a bit more humble. Let's sort of tell that voice in our head where we all have our own opinions about what's getting ready to happen next. Let's just quiet that, and instead let's just simply listen to what the market is telling us. And not just telling us now, but listen to what it has told us for as long as it has been talking, if you will, in the US and all over the world. By just doing that, by just kind of being quiet and listening, you can then start to see, well, what does the evidence tell us over time? What does the evidence tell us? What are the most prudent ways to build an investment portfolio, not based on hunches, but based on the evidence that we see? So everything that we do in Dimensional, all of these, the systems, the rules, if you will, that go into being very systematic, are all a function of what that evidence has told us is the best way to invest. And just very briefly, a couple of those things are, first, be really broadly diversified. Be as broadly diversified as you can. There are really good benefits to that. There are, from risk management, the old don't put all your eggs in one basket sort of thing, be diversified that way. But also there is a whole world of opportunities out there. And investors all over the world are seeking for places to put their money that they think there's a good chance for that money to appreciate in value. We don't want to get in the middle of what the market is telling us and what we think the market ought to be doing. So instead, we just listen to what the market is telling us, and we end up building a very, therefore, broadly diversified suite of investment solutions all over the globe. The other thing is, don't try to outsmart those markets. The market is too good at building in all kinds of new information very, very quickly. Now, this is a little counterintuitive for a lot of folks, because I think most people look at the stock market and they think, well, the way to have good investment returns is to see something nobody else has seen, to just, pick that needle out of a haystack. And so, we need to work harder or work faster or be smarter or whatever, so that we can get that informational advantage over everybody else. That sounds great, and it sounds like it ought to be exactly what you should do, or what you would need to do in order to have good returns. The evidence tells us something very different. The evidence tells us that we stop short of saying impossible, but really, really hard to outsmart markets. And all we have to do is look for evidence that tells us that, and that evidence is, well, if we look at all of the universe of investment managers, professional investment managers, who are trying to do that, they're going to pick 20 stocks, 30 stocks, and they think those stocks are going to be great.
And we oftentimes, and people hear this, our clients hear, those are considered active managers, correct?
Correct. Yes. Traditional, active, concentrated managers, stock pickers,
right.
That kind of thing.
Yeah.
To flip on the TV and go to the news, the financial news, and all day long, that's what they're doing.
Yeah.
Do this, don't do that, buy this, buy that. So again, we say, well, let's see, does that work? And when we look out across, again, all of the managers out there who are trying to do that, and you say, well, how many of them were actually able to beat their own, what we call benchmark? Just that sort of yardstick that says, for us to be really good at this, we have to do better than this benchmark. So it's a common way to answer the question, how are they doing? By comparing the returns to the benchmark. Over the last 20 years, there is something along the line, less than 20% over the last 20 years of managers that have been out there, less than 20% have beaten their benchmarks. So if this were possible to do, to find out where the market's got it all wrong, you would expect a far greater percentage of professional money managers, who, by the way, are all very smart. They're all well educated, and they've got all the technology and the tools and the research and all of those things, and they still can't do it. That tells you just how powerful of an information processing machine the market is. And so again, what that means for us is, don't try to outsmart the markets.
So you must be a passive investor.
Not exactly passive. Now you're yeah. So one of the questions we get a lot is, well, is dimensional active or are we passive? And the very unsatisfying answer to that is, well, it depends. It depends on what you mean by active or what you mean by passive. So if what you mean by active is picking needles out of haystacks, then no, that is not what we do. I will say, though, if what you mean by active is, are you trying to beat that yardstick? Are you trying to beat the benchmark? Then yes, we are.
Yeah.
We are every day trying to beat that benchmark. We're just going to do it in a much different way than that traditional stock picking, bond picking manager is going to do it. If on the passive side, if by passive you mean indexing, so you may be familiar with index managers and what they do. There's big companies out there, I don't have to name them, that track things like the S&P 500, Standard & Poor's 500, and lots of different indexes around the world. An index manager is really, really passive. I mean, so they really don't do anything except just track that list of stocks or that list of bonds. The S&P 500 is a list of 500 stocks that the company Standard & Poor's S&P publishes. And so they put this list out there, and if you are an index manager tracking the S&P 500 and you say we are an S&P 500 index fund, you don't have a choice. You have to buy those 500 stocks in exactly the same proportion as they say. And then once or twice a year, maybe, they'll change that list. Take these 5 out and put that 5 in. And if you're an index manager, you have to do those same things. Take those 5 out, put these 5 in. So that's an index manager. That is as passive as you could possibly get, because you make those changes once or twice a year and then you don't do anything. Right? So we're not that. We're not index. But if what you mean by passive is, be broadly diversified, keep your costs low, be mindful of the tax experience maybe that the investors and the funds are having, and try to limit, the amount of taxes that might, have to be distributed, the amount of gains and that sort of thing. If that's passive, then yes, we are passive. So what we're ultimately doing is taking what we think of as the best things that index managers are trying to do, that those traditional active managers are trying to do. Let's take the best of those things, but then let's understand why those might not be the best things to do. What gets in the way of the act? Why are only 20% or less outperforming benchmark? Let's understand what gets in their way, and then try to avoid those things if we can. Indexing, a little harder to understand where maybe indexing is falling a little bit short, but we know that because an index manager can only change the portfolio a couple of times a year, it would be great if stocks and bonds only traded a couple of times a year. But they trade every single day. So it's the inflexibility that an index manager has that we think leaves some returns on the table. So we like what they're trying to do. Let's incorporate that broad diversification and low cost, but let's give ourselves a little bit more flexibility. Let's allow ourselves to come in every day and look at what the market is telling us again. And if we need to make small little changes to the portfolio, and we can do it where net of all of the costs of doing that, we think the investors will be better off, then we can do that. Mm-hmm. And so we think we're able, with that flexible process, to pick up some returns that an index fund can't, just because of the structure.
And you do this all under that stack of evidence.
Yes, exactly right.
So going back to that original kind of where we began,
yes,
is the evidence. So tell us a little bit about what the evidence has shown that the markets produce for us, where returns come from.
Where do they come from?
Yeah.
So and this again goes back to listening to the markets for 90 years all over the globe. We find that the market's telling us these same things. That rather, if you want to have an investment portfolio that has a good chance of doing really well, of beating those benchmarks, rather than picking that individual stock and guessing which company is going to do well if the Fed does this next week, or if this happens in the presidential election or something, instead of having a good performance experience by doing that, it's the characteristics that a stock exhibits. Okay, so what do I mean by that? There are certain, and sometimes I think of these as neighborhoods, Christopher. And I hope this works. It works in my head, okay. But hopefully it works for you. So it's not really the house; it's the neighborhood that the house is in. What are the 3 rules of real estate?
Location.
Location. It's the same sort of thing when I say characteristics. So in the stock market, a company, a stock, is either a small company or they're a large company. Of course, there's a spectrum in between those two things. They're either a small company or a large company. Research tells us that small companies have outperformed large companies through time for very good reasons. Okay? So one characteristic that seems to have rewarded investors is small companies rather than large companies. So from my neighborhood perspective, if any house that would be in a neighborhood, quote unquote, of small companies, we, just before even thinking about anything else, think, okay, that neighborhood probably has a better chance of outperforming the neighborhood that has just large stocks in it. Okay? That's one characteristic. The research calls that the small cap premium of performance over what large caps have offered. A second one is the price that you pay. We call this relative price, the price that you have to pay for a stock. And we don't mean just is the stock trading at $10 instead of $20. We mean that price that you see in the market today compared to some fundamental of the company, what its earnings are. So price to earnings is a commonly known thing. What is the price compared to the earnings of that company? What is the price compared to the sales of that company or the equity, book value of the equity of that company? We have found that when you pay a lower price for that fundamental, you have been rewarded more often than if you had to pay a higher price for that. Okay? So, and that's intuitive to us as well. So what that means, again, from my neighborhood perspective, if you go into a neighborhood and you like all of the idea of living in that neighborhood, which house would you, without knowing anything else, have the expectation that it would appreciate more in value than any other house? Well, probably the one that's trading at the lowest price per square foot. It's more important for that, and because you're in the neighborhood, than it is, well, how many bedrooms did it have? How, did it have a pool? Does it not have a pool? It's, are you in the neighborhood? And then what am I paying per square foot in that neighborhood compared to other houses? And you would expect the one that you'd pay less for would have greater appreciation. That's what's known as the value premium. So value is another characteristic that is in the marketplace. The third one is profitability. This is maybe the most intuitive of all. Stocks that...
We think so.
Yes. This is the stuff where you go, geez, it took lots of smart people to say that more profitable companies are better investments. Yes, that's right. That's right. That's where maybe...
I too can be an academic.
Well, I was going to say, and we maybe take ourselves a little too seriously on this side of the business. And all that says is that companies that are exhibiting a high level of profits today, one, those profits tend to persist into the future, depending on how you measure it, but it persists into the future, and those companies have performed better than stocks with lower profitability.
And so dimensional, we call them dimensions, right? You guys
we do, yes.
Dimensions, so it's the dimensional approach. And that third dimension of profitability was actually is the newest dimension, correct?
Yes.
And what's interesting about it, it's kind of a bit of a takeaway from the small, right?
Meaning it's a little different?
It's a little different.
Yeah.
Like it from a portfolio where you're allocating the dollars, it changes the composition.
Yes.
And what we love about dimensional is this work is continuing to be ongoing. So they don't become sort of, lazy in the knowledge that you have. You're continuing to drive more information that could change the portfolio based on, like the market, new data enters the picture, the market adjusts, new knowledge, research enters the dimensional collective group. It could change the portfolio after it's vetted.
That's right. It all goes back to what is the tallest stack of evidence that we can find. And if the evidence tells us that there is now a taller stack of evidence doing something different, then we will do that. It's almost like we don't have any choice. We're fiduciaries. We all have our opinions and hunches and all of those things. Right. Being a fiduciary means you can't invest based on those things. You have to invest based on what the evidence tells you. But it might be helpful, because I didn't touch on this earlier, where the evidence comes from.
Yeah.
So I mentioned it comes from markets, but who's collecting and analyzing and trying to draw conclusions from what this data is telling us? The academic community is really always has been the vanguard of what, and I'll say vanguard with a small v. We like vanguard with a capital V as well. They're very nice folks, but I don't mean that in that sense. So the academic community the finance professors and all of these folks who their whole lives are just meant to research markets. They're really after this sort of truth, if you will, of what is going on in markets. Let's take all the commercial interests out of it. Let's take all the what can we do that's going to bring in lots of new money. They work for universities. Their job is to just try to answer that question. In our case, what drives returns? What drives returns? So the evidence that we invest on largely comes from the academic community. In fact, Dimensional's been around for 42 years now, and even before the founding of the firm, we established really deep relationships with some of the leading academics in the world. In fact, we've had 5 Nobel laureates be affiliated with Dimensional over the years. And all but one of those, the other 4, received their Nobel Prizes after they began working with Dimensional. And so that tells you this is Nobel Prize winning research. It's easy to go, somebody's just been given a Nobel Prize and then you call them and say, hey, how would you like to
join our team?
Right, exactly. A little bit more difficult to find them before they get their Nobel Prizes. Right. So, and with the work that they have done with Dimensional over 42 years has been very collaborative. They all still have they all still teach. So we really just use them as almost a sounding board. So they've come up with these ideas about what the market is doing. Our job is to try to translate those ideas into real world, real life portfolios that people can actually invest in. So it's a little bit more fluid than just the way I'm describing this, but it's almost like they're the ideas and we're the implementation. Now, over 40 years, we've gotten to be very good at the ideas as well. So it's more of a fluid relationship, dynamic relationship. But for instance, when our internal research team, we've got 330 or some odd people dedicated to just the implementation of these ideas and also doing research, we might notice something in the market, or we might have some idea, maybe we should be making this small adjustment to the way we're managing these portfolios. We don't just go, well, our internal team found it, let's go do it. We in essence have to get in a room with these Nobel Prize winners and say, well, here's an idea that we have. And their job is to vet those ideas with everything that they've learned how to do in their academic careers. In other words, they're very, very experienced in asking the question or making the statement, yes, but. Well, I see that, but have you thought about this? Have you thought about that? If you think about, and I've never been a PhD student, but I think the way this works is if you're a PhD student, you've got these faculty, folks that you've got to go present your very well thought out and hopefully very well articulated idea to. And then they all sit on the other side, very stone-faced. I can almost picture them going, and very skeptical of all of this stuff. And their job is to try to figure out where there's some holes in your argument. Okay, it is exactly the same thing at Dimensional. Before we do anything, we're in this conversation with these folks, and they and we are trying to find holes in our argument. And as one of the folks that we've worked with since the very beginning of the firm, a guy by the name of Gene Fama, Nobel Prize winner at the Booth School of Business at the University of Chicago, he's fond of saying our job as academics is when we're presented with data is to beat that data up with everything that we know how to. All these tools that we have as statisticians, as researchers, as everything where we think people sometimes just are a little too quick to go, we beat it up with all of those tools. And then if it's still standing after not only one person, but this whole team of academics beats it up with everything they know, if it's still standing, then we've probably got something here. Now just think about what that means for building and managing portfolios, especially in a world where there's a 24-hour news cycle, financial news cycle even. We mentioned it earlier, you've got entire networks on television and online telling you buy, sell, buy, sell, buy, sell. It seems like there should be something new you should be considering every single day. You can't find a more diametrically opposed process to that than what I'm explaining at Dimensional. Because, yeah, there are lots of interesting things, but they fail when you subject them to that scrutiny that I'm talking about. And again, I said it before, maybe it would be nice, maybe it would be easier if we could just invest on our own hunches. But we're not. We're investing somebody else's money. And so the changes to the portfolio that we make, you mentioned profitability, that was 2012. it's once every 10, 15 years, maybe some big new thing happens in the portfolio. Now, the other part of it is in the implementation of those ideas. A little bit more frequently, as markets evolve, as data evolves, as costs and frictions come down a little bit, maybe there are opportunities then for us to do something when we're buying and selling inside the portfolios. And we have lots of innovations that have happened in that part of it as well. So it's this is all, Christopher, going back to the question then of why in my role as CIO did I adopt dimensional?
Before we go there, we're going to take a short break.
Okay, thanks.
CMB Treasury Management can streamline your payments and collection processes, manage liquidity, and resolve the working capital challenges businesses face today. Our products and services are designed to help you devise the best combination of services for your business. No matter the size of your business, let us help you with solutions that can best fit your needs and positively impact your bottom line.
All right, welcome back. Thanks, Paul, for being here.
Of course, yeah.
I've really enjoyed the conversation. We want to get to the question that we always ask all of our guests, and that is, what is wealth? So we're not asking what does wealth mean for Dimensional. We're asking what does wealth mean to Paul?
Oh, for me, personally. Okay, what is wealth? My first inclination is to separate this concept of wealth from net worth. And I think that's important. I think, and it's particularly important probably in what you do, and what you were describing earlier. When I was at the bank, we used to tell ourselves internally before we would meet with clients, let's remember that the goal is not to, for most people, not to die with the tallest stack of dollar bills that they can have over in the corner.
Right.
That's not it. It is the point of the money is to have the sort of life and perhaps legacy that they think will end up making the world a better place. The individuals that they care most about, the institutions that they care most about. That's really what people are after. Even if they walk into our office and they say, I just want to beat the S&P 500. We used to say, nobody on their deathbed, even if they walked into our office saying that, ever looked around to all their loved ones who were gathered around, and then they said, and best of all, thank goodness we beat the S&P 500 by 75 basis points.
It's not a conversation, right? That is not a conversation.
No, it's
reading
not.
The will.
No, that's right. You maybe this is a highly idealized vision that I have, but the conversation is something like, gosh, and we were able to put the kids through school, and we were able to take some nice vacations. I was able to spend my time doing what I wanted to do. And now after I've passed, the church will have new pews or new robes for the choir, whatever the case may be. That to me is wealth. So I think wealth is more qualitative than quantitative, and it is in essence having the ability to live the life that you want to live.
Yeah, I might say that flexibility.
Flexibility.
Yes. That's how, for me, wealth is, there's a component of flexibility in it.
Yeah.
And I say security.
And Holly says security.
Yes. One example I'll give, being from Toledo, I'm a Detroit Tigers baseball fan. And every once in a while, I'll be able to find myself down in Lakeland for spring training. Okay. And so I'll go to a game. First of all, hard to get a ticket to the game, but it happens every single time. I'll buy one ticket because it's just me. I'm down there on work or something. So I'll buy a single ticket, and it'll be in the middle of what I come to figure out are lots of like season ticket holders for the spring training. And you would think that this was Central Michigan, South Central, Southeast Michigan, Northwest, just lifted out and replaced down in Lakeland because they all know one another. I hear people all the time saying, "Oh, Christopher, how are you? How's your folks doing?" And I think, to me, I go, how nice would that be? To just be able to go to some other place and have this community of people that have the flexibility to be able to spend some time down there. That's wealth. Now, net worth, finances, investments, all of those things played a role in that, but that's not the wealth. The wealth is being able to go every spring down to Lakeland, see people that catch up, on old times, and follow your favorite baseball team.
Right. So performance becomes less of a topic in our conversations with our clients. It's always a topic, of course, and we want to be accountable to did we or did we not perform the way we think the portfolio ought to. But really, our clients are judging us on were they able to achieve their goals? Mm-hmm. Were they able to send that tuition payment for their grandchild? Were they able to go to Lakeland? Yep. So that's really how we measure our success, when we can say, yes, go ahead and do that annual gift. Yes. Because you can do that.
Wonderful.
So, I mean, I love the way that you're defining and the conversation around wealth, because, again, we want to sort of define it for every individual client, know what that is, and then be able to work towards that. And that's what Holly and I and our team does every day, and we think we do it really, really well.
I would agree with that, by the way.
It's actually the best part of the job. Not just, the performance, great, but the best part of the job is actually sitting down with them and showing them how we're going to get them from A to Z.
Yes.
And then when you get them close to Z, they're so excited about it, and they're comfortable and they're confident, and they can actually walk away not being worried when someone's screaming at you on the TV to, buy dirt.
Yes.
So that is the best part of the job.
Yeah.
Well, Paul, thanks so much for your time today.
Sure.
We appreciate you being here. Have fun with your family.
Thank you.
Later
Looking forward
this
to
week.
that. Yes.
So thank you again.
Okay. Thank you. Thanks.